Well, sentiment soured last week with the S&P 500 notching its biggest weekly decline since April as the market digested a barrage of negative headlines and a dose of increased uncertainty as well, including, of course, Joe Biden dropping out of the presidential race over the weekend. Political news flow likely to take centre stage this week as well, with the data docket relatively light. Just the latest PMI surveys and the first read on second quarter GDP, the main highlights standing out from the economic calendar, while the BOC, of course, decide policy as well. And earnings season remains in focus as the pace of reports ramps up, including some of the big tech names such as Google and Tesla. Plenty for myself and Ryan Littlestone to discuss on the trade-off this week. Without further ado, let's get into the show. So plenty to digest on the trade-off this week. Let's not hang around and bring in my co-host as always, Ryan Littlestone from Forex Flow Live and Forex Analytics. Ryan, a very good afternoon to you. We had our 2 days of British summer on Thursday and Friday last week, and it seems the grey skies and drizzle has returned once more.
Yeah, I count myself very lucky. I took Friday off, so I managed to enjoy the sunshine, get down the beach here in Bournemouth, burn my head, and do a bit of swimming. So all the status quo for me in the summer, but yeah, it's a school holiday, so it's bound to go rubbish.
Well, indeed, that you're exactly right. It's the school holidays, the test matches are being played. It's perfect mixture for the weather to be a little bit sour. But this is a market show, not a weather forecast, and we've got plenty to discuss in the realm of financial markets. So let's crack on with Topical Thunder. So I want to start this week with, what happened on Sunday afternoon. And may I just put on the record right now that our producer, Kyriakos, was very, very pleased and happy indeed with the couple of puns that I've made here, although I think your reaction may be somewhat different, Ryan. In any case, what seemed to be inevitable finally happened on Sunday evening UK time, Sunday afternoon in Washington, D.C., with Joe Biden suspending his re-election campaign and announcing that he's going to turn down the Democratic nomination. Within about half an hour or so of doing that, he endorsed Vice President Kamala Harris for the nomination, and you would expect that to be confirmed at the Democratic National Convention in Chicago, which is around about a month or so away. Although it is worth noting that there's no mechanism for Biden's delegates to automatically transfer to another candidate. So there is some potential for uncertainty surrounding that nomination. And of course, we don't know who Harris's running mate is going to be, and that will be another interesting aspect to the presidential race. Nevertheless, the high likelihood is that we now have not a Trump versus Biden contest, but a Trump versus Harris contest going into November. Now, initially, my reaction to this would be that the race is now substantially more open and uncertain than it was when Biden was running. I think most of the polling was pointing to, particularly in the swing states, Biden really struggling to gain any sort of foothold, and actually the election potentially being a near wipeout for the Democrats. You would argue that things are likely to close up and the polls are likely to narrow quite significantly now that Biden has been replaced at the top of the Democrat ticket. And I think the uncertainty that brings should make it a little bit harder to price risk around the election. And of course, we're talking about the election a lot earlier than you perhaps would usually expect. Normally, the political campaigns don't really get going until after Labor Day weekend. Here we are 6 weeks out from Labor Day, and the campaign is pretty much already in full swing. So I think politics is going to remain at the forefront as a market narrative and as a driver of price action as we move through the summer and into the autumn. And then, of course, you've got to consider, some of the moves that we saw over the last week or so. A lot of participants were talking about this potential Trump trade, some of the dollar gains that we saw, some of the rotation in the equity space. Was this down to increased bets on President Trump or former President Trump retaking the White House? If that indeed was the case, then perhaps we see some of those moves reverse course a little bit. But Ryan, what's your sort of initial thoughts on what I guess was the inevitable break happening over the weekend?
Yeah, very interesting when I saw your title and your header for this one. So for your Biden comment, there's a yellow card.
Oh no!
For your it's all Jova pun, there's a second yellow card, which obviously means you get a red card. So you're off, mate.
I'm off. Bye.
Crap, I'm doing the rest of the show on my own.
Well, you got rid of me.
Yeah, thank you very much. See you next week. No, so yeah, we are firmly in election trading, and that was key. We did see this Trump trade, let's call it that, over the last couple of weeks. Various assets moving, like the Mex weakening because obviously he's had bum fights with Mexico before, and I think this is probably one of the earliest that we've seen real trading coming into an election. I mean, we didn't even trade this close, this amount of stuff for the UK election, and that only gave us like a 3-week lead up. So, yeah, we've seen a lot of these moves. I think it's going to be an indication of what's to come nearer the time. These moves are probably going to pick up a bit of a head of steam because every weekend, they're commenting on one policy or another, and it's all airy-fairy as part of the campaigning. When we get to the super nuts of it and really find out what either party's going to do, and it's still favouring that Trump's going to be the one who takes the hot seat, then we're going to really ramp up on this trading. So for now, we are seeing moves. We didn't see too much of a move last night when the markets opened and they could react to this Biden trade. Harris is just sort of a Biden Mark II, really. She's in the same vein, just younger. She's getting a lot of backing from some of the donors. But we've got to get to that Democratic conference or convention where they will rubber stamp who's going to be the nominations. There's plenty of time for others to throw their hat into the ring in the meantime. And then the market might react again depending on who's going in. Is it someone more moderate? If it's someone, extremely, Biden orientated, shall we say, the market's going to change around for those expectations. But for now, elections, and you, the one who hated it the most, and here you are doing topics about it now.
Well, indeed. I mean, the only reason I brought the topic up was so I could use those puns, really. I hate the bloody subject, but I feel like we're going to be talking about it every week now and until November, sadly. And, maybe I'll get red carded every week until then. But anyway, it is a pretty US heavy start to the show this week, because I think you want to dig into some of the data that we get over the next 4 or 5 days as well.
Yeah, very much so. We're starting to get the run of GDP data for Q2 coming out from many countries. Thursday, we get the US Q2 numbers, and a rather disappointing Q1 of 1.4% is expected to increase, to improve to 1.9% for Q2. And this data will have a big effect on the Fed rate cut pricing if there's a big variation. Certainly, a softer number will increase the chances for a September cut, and a disaster number may even get July pricing picking up quite a bit. This data will show how smooth the soft landing is going to be in the US if we get a landing at all, of course. We also need to pay attention to the PCE data within this GDP report, because it's one of those funny times of the year where we get the monthly PCE that's estimated in this GDP number the very next day. So we get that on the Friday. Now, supposedly, the real PCE data isn't part of the estimated GDP, even though they must have the real numbers by then. Either way, the PCE component will be watched closely, which means Friday's PCE shouldn't rock any boats. Now, Friday's PCE is expected to drop 2 points to 2.4%, with the core dropping a point to 2.5%. But more importantly, it'd be some of the underlying PCE components like services, inflation, and rents, and all that housing stuff that's going to get the greater attention to see if they have followed the same downward trend or pattern that we saw in some of the CPI numbers. So aside from all the other data points we get this week, these numbers will really likely cement pricing for the Fed over the next 2 meetings.
Yeah, I think you're absolutely right. I think this is by far and away the most interesting release of the week. I would just say I think the market already prices a September cut at about 92, 93%. I don't think you're going to get much more of a certainty than that, no matter what. Well, certainly if the data's cool, I don't see that moving much more in a dovish direction. So perhaps there's scope for some of those bets to actually unwind if the PCE figures were going to come in a little bit hotter than expected. But I think some context is important around the GDP print in the United States. Obviously, this is an annualized quarter-on-quarter print, but it's still, I can't do the maths in my head, but it's going to be quarterly growth of about 0.4, 0.5%, depending on where we are compared to that consensus figure. And actually, that's vastly superior to what we see in the most of the rest of developed markets. I mean, the UK outpaced that in Q1, is unlikely to do so in Q2. Europe is stagnating at best. Japan, similar. China, the data's made up, so you may as well just ignore it. And I think if anyone is arguing, and I think I might be discussing this later, actually, I can't remember which charts I put in the slides now, but actually, if anyone's arguing for a sustained dollar downturn, they really need growth in the rest of the world to pick up substantially above the pace of that seen in the United States, and that doesn't seem likely to happen just yet.
No, very much so. And talking to Blake earlier today, he was saying, what's going to cause a change? How's European growth doing, UK growth doing? And we're just
what growth.
Yeah, exactly. We're just bumping along the ground, and the US is sort of still flying the plane in the air, although it is sort of heading lower. So you can't really see a significant change coming from anywhere else, like you say, to favour the fortunes of the dollar over weakening US growth. But the dollar's compounded or confounded expectations time and time again. The data's confounded expectations. So you never know with this one. We could get a higher print. And like you say, that PCE could come in hotter. And
yes.
Then the market's going to, add to or take away from that September pricing. And, we'll get a few banks playing blind, pin the tail on the donkey with the calendar again.
Any excuse to bash the banks. I was going to say, we're talking about soft landing, no landing for the US economy. I don't think Europe and the UK have really taken off yet. That's where we are in terms of the aeroplane analogy. Speaking of the UK, I want to talk about the Bank of England because it was a big week of data here in the UK last week. In fact, probably the most important week of economic data we've had in some time. And actually, it was a bit of a mixed bag, and I think really muddies the water and clouds the outlook when you're trying to make a high conviction call for the August MPC decision. So taking those releases in turn, inflation, headline CPI remained unchanged at 2% year on year for the second month in a row. Of course, this data referencing June. Core inflation also held steady at 3.5%, while services inflation, that was steady as well at 5.7% year on year. All of those are a touch above market expectations, but perhaps most importantly, the services CPI figure was a whopping 0.6% above the BOE's own forecast, as they outlined in the May inflation report, the May monetary policy report, I should call it. So there's clearly, in my mind, no signs that persistent inflation is being stamped out of the economy with core and services prints of that nature. We then moved on to the labour market, unemployment holding steady at 4.4% in the 3 months to May. That's its highest level since the middle of 2021. And although there's some signs of earnings growth cooling just a little bit, with the including and the excluding bonus measures falling to 5.7% on an annual basis over the same period, that is still a pace that is incompatible with a return to the 2% inflation target. So you've got inflation at target, but the details of that inflation print are still relatively sticky and relatively stubborn. A jobs market which is starting to loosen if you look at unemployment, but earnings pressures remain relatively intense. And then just to make things even trickier for those of us trying to second guess what the BOE are going to do, Friday's retail sales report showed increasing signs of concern over the state of consumer spending, with sales down around 1.2% on the month in June. Obviously, this was coming off a very, very strong month-on-month increase in May, but that was after a dismal April. So all of that nets off to, well, still signs of concern. A few people pointing to the dismal weather that we had in June as an excuse for that rather grim sales print. But however you cut it, really, retail sales are not doing particularly brilliantly at this moment in time. Now, I think we may disagree here, Ryan, but my gut feeling after the inflation figure in particular is that the MPC are now likely to err on the side of caution, and having previously expected a cut in August, I'm now pushing back that expectation until September at the earliest, Although I would say I think August is still going to be very, very finely balanced. The main case for the BOE to go and deliver a cut in August is that they have a press conference, they release their latest economic forecasts, and they won't have that opportunity again until the November Monetary Policy Committee meeting in terms of the forecasts and the press conference. So that would be the argument in favour of getting a cut done and dusted pretty quickly. But whatever happens, I think it's going to be, one, a split vote on the MPC, and two, an absolute communication shambles, no matter the policy decision that they decide upon.
No, I think I agree wholeheartedly with that. If we take the data points one at a time, CPI data, that hasn't changed since the June BOE meeting. So if there were people sitting on the fence over that, there's nothing in that CPI data to change those minds then. The labour market, yes, we've seen a little bit of unemployment ticking up, but again, those wages very, very sticky, and that again is going to keep part of their mandate on the table, that they need to keep hitting, keep rates higher to offset that. Retail sales, we said it a few weeks ago when we got that bumper print, 2.9%, was it 2.4%, whatever it was, that I expected retail sales to be negative the month after, because it'd been a poor weather month, and also that there's going to be some snapback for that. So overall, if you look at the trend for retail sales, it doesn't really give you a clue either way. You could say it's a bit soft. Overall, for the August meeting, I still think maybe there's a little bit of underpricing, purely on the back of the fact that they are desperate to cut. They really want to cut. And it's just a question. I go back to Bailey. He said in February, that they don't need to wait for inflation to get to their 2% target to cut rates. Well, here we've got 2 months on the trot where they're at target. And he also said one small 25 bit cut won't reduce the restrictiveness that they've got in place. So they could do a little cut in August just to get that ball rolling, just to, mention other parts of the economy or whatever. But overall, I think they probably do stay on hold. And well, you're playing the same pin the tail on the donkey with September as well, but that's likely. But we'll get another month of data like this, and the market's going to push out even September.
Yes, indeed. The other, just two final points on this, and both are a little bit of a moan, as is typical at this point in the trade-off every week. The first is that I was going to say, make yourself a cup of tea. The first is that the labour market data, I mean, the ONS are just beyond a joke now at this point. It has been a year, almost exactly a year, since the ONS identified these issues with the labour force survey that were causing the unemployment rate to be what they were calling inaccurate and unreliable. They previously said that they would have a transformed labour force survey ready for September. They're now saying that is not going to happen. Why it is that every single other statistics agency in the world can provide an accurate read on the labour market, but we can't, is entirely beyond me. And that certainly doesn't help the BOE when it comes to trying to set policy. And the second thing I would say is that actually I think the BOE's communications of late have been, well, I was going to say dire, but actually, frankly, almost non-existent. We have not heard from Bank of England Governor Bailey for just over 2 months now. The last time we heard from him was the end of May. Of course, the BOE went into this self-imposed blackout period over the election campaign, but that was over 2.5 weeks ago. There's been plenty of time if Bailey wants to get on the wires, or if any of the other policymakers at the BOE, Lombardelli, for example, she took up a post on the MPC at the start of July. We've got no idea what her policy views are, and they're now in the blackout period ahead of their meeting on the 1st of August. And I think this is another reason why markets and actually observers like ourselves are having such a hard time reading the BOE and having such a hard time deciphering the policy outlook here in the UK, because they have not been at all clear on what their reaction function is and how they're viewing the data. And I think ultimately that's contributing to perhaps unnecessary volatility in sterling assets, whether that be the FX space or the rate space. But rant over, and I'll let you move on to the BOC.
Oh, sorry, is it back to me again? I nodded off for a minute there. I nearly got another yellow card. I'm going to talk about another central bank, the Bank of Canada. Well, you say, how do other agencies produce data? Well, the Canadians aren't exactly top of the list when it comes to that. I don't know if you remember the old Canadian ADP numbers that will come in plus 500 one month and then revised to down 800 the next month.
Yeah, the ones they quietly stopped publishing after a while.
Yes, all of a sudden they disappeared off the radar. So, yeah, they're just as bad as us, but two wrongs don't make a right, of course. Now, according to market pricing, the BOC rate cut is pretty much nailed on. They're over 90% as a probability. We know that the BOC have already started their cutting phase, and we'll know whether more is going to come or not. But the rate cut this meeting isn't going to be the important news. The real news from this meeting will be the BOC's tolerance for diverging rates with the Fed. When they cut in June, they told us that there's a limit between how much they were going to cut versus whatever the Fed were going to do. The implications for this is so that a big gap didn't open up between the Fed and BOC rates. Now, if the if the BOC do move to 4.5% on Wednesday, that would create an 87.5 basis point difference in rates from the Fed. Now, for yield chasers, that would favour the US over Canada, which would then see potential flows out of the Canadian dollar into the US dollar. That would mean Canadian dollar weakening. You then have the added implication of inflation coming back in due to the weaker currency. And that's something all central banks are worried about regarding their own currencies weakening. So for me, the biggest news from this meeting is finding out how close the BOC would be to their limit regarding this divergence, as that might even limit the future rate cuts until the Fed start to cut themselves. Or it might even give us an indication of an impending Fed cut if the BOC are happy to let things carry on. Let's not forget that these guys are talking to each other all the time. And if the BOC know that the Fed are going to cut over the next few months, they'll be happy to continue cutting also. So there's several plates spinning in the air for this one that's going to make it more of an interesting meeting than just whether we get a rate cut or not.
Yes, indeed. I fully agree with all of that. I think it is going to be an interesting one from the BOC this week. But I would say that back-to-back cuts do seem likely to be on the cards, particularly after that disastrous retail sales number on Friday. I think sales were down almost 1.5% on the month in May, and the estimate for June wasn't particularly pretty either. So it is obviously worth bearing in mind the potential divergence between the BOC and the FOMC, but also the BOC and G10 central banks more broadly, because the vast majority look to be, either waiting until the early autumn to deliver that first cut, or if in the case of the ECB, for example, and the Swiss National Bank, having delivered a cut, but now looking to remove restriction at a relatively gradual quarterly pace, whereas the BOC are accelerating that normalization process at a much, much quicker clip. And I think that is just one to keep on the radar and could potentially put some downward pressure on the loonie as we move through the weeks and months ahead. But I know you're going to talk about that at length in a little while. So why don't we move on to That's a Setup and have a look. Right, Dollar CAD is coming right at the end of this segment, so hopefully I've whetted your appetite sufficiently for that. Before we get there, I want to talk about the S&P 500 and risk more broadly, to be completely honest with you, because obviously we had that relatively chunky downside in the equity space in the United States last week. The S&P down around 2%, its worst week since April. The NASDAQ down over 3% last week. And some would argue there's been no real catalyst for the move. I think I subscribe to that view. I mean, clearly the move in the S&P and certainly that of the NASDAQ has not been helped by this continued sector rotation out of growth names and tech stocks into more of the value and cyclical parts of the market after that cooler than expected June US CPI print. That rotation continued last week. We also had just a general sort of barrage of uncertainty and bad news hitting the market. There were reports that the Biden administration, as it still is at the moment, were looking at tougher curbs on Chinese chip makers. There was an interview with former President Trump where he was casting some doubt on the US's desire to continue defending Taiwan. And then obviously we had all sorts of global IT problems on Friday, which are way above my head to try and explain. But safe to say it was a pretty ugly situation when you've got, the banking system coming to a halt and flights being grounded and all the rest of it. So a lot of bad news that hit the market. And of course, this is coming at a time of year when volumes are traditionally relatively relatively low and liquidity is relatively thin because everyone is starting to go on holiday and enjoy the summer, and there are fewer people actually participating in the market, which as a result would likely have exacerbated the move lower. So personally, I see this as more of a blip than any sort of change in the trend of the equity market. We're still above, of course, as you can see on the chart there, the key short, medium and longer run moving averages. And fundamentally, the core bull case that I've been harping on about for most of the year in terms of solid economic growth, as we mentioned a moment ago, solid earnings growth, which has been relatively resilient thus far. And of course, the idea of the Fed keeping investors confident to remain further out on the risk curve, there is still a tick in all three of those boxes. So certainly I continue to view any dips as buying opportunities, but for the shorter term traders out there, I think the key levels to watch on both the S&P and the NASDAQ are the 50-day moving averages, which the market is happily rallying away from this morning.
Yeah, this is one of those times where you've got two different contexts to the charts. You look at this chart that you've got showing as one context, it looks like a minor pullback. Anyone who's watching an hourly or 15-minute chart is probably thinking, oh, this is the end of the stock market again, because it's just done nothing but go south. So you always need to flip in and out of your different time frames just to get the overall picture. I think, yes, we've seen a lot of this rotation going on. Some of the more traditional stocks are seeing people, money flows into that. I think this is one where at the moment we're in that orbit of the Fed next week. We've also got this GDP data. We're still in earnings season. So there's a lot of moving parts behind this. GDP, I think, is going to be the most important, because if we do see a far more weaker US economy, it's going to be interesting to see whether that impacts stocks. Do we then see a rotation out of the traditionals back into the tech stocks, or are we going to see all stock markets falling just on the back of weaker economic data? And then we can't rule out the fact that stocks might rise, because it means softer data means that the Fed get closer to easing, which brings back the cheaper money to buy stocks with argument. So this is a real funky week. At the end of the day, all you can do is trade the levels. So if you've got your support areas, you know where they are, focus on those, focus on the resistance areas, what the price needs to do to change things around. We know it's going to break to fresh highs. Even if it breaks by 5-10 pips, it means the trend is still in play and we're going to be heading higher. So just trade the levels. Don't get too caught up in the what's going on underneath.
No, I would fully agree with that. The other thing I would say is, not only timeframes and zooming out and a bit of context important when you see a move lower in the equity market like we did last week. The other thing that you always see is folk on the internet coming out with absolutely stupid predictions. I saw a tweet this morning, and I will leave the name out of who posted this. You can go and find it. If it won't be hard to find. Calling for a 30% decline in the NASDAQ and a 25% decline in the S&P by October. Get a grip. I mean, just no.
I'm going to save this one, because if it does happen, then I'm going to rub it in your face that we got a 30% decline in 3 months.
I'll tell you what, if we see a 30% decline in 3 months, the least of our worries will be gloating on the trade-off, because it probably means we're in the middle of World War III and we're filming this from a bunker somewhere.
I'll be short in that case.
Well, yeah, exactly. I'm just going to go and stock up on beans. Right, while I do that, why don't we talk about crude?
Yeah, I'm going to talk about oil. And again, it's another part of the election trade, and WTI US oil is trading through support around the 80s level at the moment, which is a bit of a pivot zone between 80 and 80.50. One question I think that's not being asked regarding US politics is, what would Trump do with the SPR, the US petroleum reserves, if he wins the election? We know he's griped about Biden releasing oil from it, and when he was last in office, he wanted to fill it to the brim while prices were low. That was blocked by the Democrats in Congress at the time, and it would actually have been a great trade with oil down near those record lows. Last week, he said that the US would drill, baby, drill, as the increase in production would then lower prices for consumers. That's him, not me, mate, not me.
I didn't think it was you, mate, don't worry.
Good. I just want to make sure. Therefore, it naturally looks like he wants to try the same trade again and will act to try and lower prices which will then allow him to fill up the SPR at lower prices if he's not blocked again from doing so. For oil prices from here, as I say, we're sitting below this 80 level, and we could be heading even lower if Trump gets in and goes to work on production. That could mean we're heading back towards the mid-low $60 mark in the months ahead. Now, if that happens, that's going to bring its own problems, because how OPEC and OPEC Plus would react to that is another part of the puzzle for oil traders that you'll need to be aware of. What's clear is that the growing list of assets, market assets, that are going to be impacted by this election over the months ahead is just getting bigger and bigger. Here again is another one. Oil stocks are going to come into it at some point. We've already seen the Trump trade. So again, lots of different impacts that come into this oil trade. If Trump gets his way, then we could be heading lower.
Yes, indeed. It is certainly going to be interesting. And if the 2016 to 2020 Trump presidency was anything to go by, he's not going to be too concerned by OPEC and their protestations in the media, shall we say. And that drill, baby, drill phrase, I think is going to be used again and again, particularly when you consider from a political point of view, where are the votes that Trump needs to win? They are in the oil drilling regions of the United States. They are key regions that he needs to win in order to reclaim the White House. So I don't think that rhetoric is going to quieten down anytime soon, to be completely honest. And of course, more supply coming onto the market as the demand outlook remains relatively fragile. That's probably only going to send prices one way.
Yeah, exactly. And if he does turn around the economy, or if the economy does turn around, that will bring the demand. So that will fill part of that gap. But otherwise, I at the moment, just sitting here, I see this heading a bit lower before we start bouncing again.
Indeed, I tend to agree with you on that one. Right, moving on. Something else that Trump was talking about last week was not just crude, but he was also talking about the dollar. He was saying that the US has a big currency problem in the eloquent language that he loves to use. The US doesn't really have a big currency problem, let's be honest, because the dollar hasn't really gone anywhere for most of the year. Although we did see a very, very brief break below the 104 handle in the dollar index last week, although we are now comfortably back within that range. And interestingly, we closed just north of the 200-day moving average on Friday. I see very little reason to expect this range to give way anytime soon, although I think participants will now be watching those prior lows that we made last week around 103.60 very, very closely indeed, particularly those looking to play this from the bearish side. But fundamentally, I think, as I said earlier on, if you are looking for a sustained dollar downtrend, you need growth in the rest of the world to pick up and outpace growth in the United States. And arguably, you need the Fed to cut at a more aggressive pace than other G10 central banks as well. And neither of those look set to happen at the moment. In fact, I would argue that Fed pricing seems a little bit overdone, with the curve discounting around 60 basis points of easing by the end of the year. I think 2 cuts, i.e. 50 basis points, is likely. But of course, remember that the dot plot after the June meeting, the median expectation there was just for 1 cut this year. So there is still plenty to play for when it comes to that pricing. And I think as a result of that, we should see the dollar continue to recover some ground after that very, very brief foray below the bottom of that range last week. And the key thing, of course, to watch is the GDP print on Thursday. If that is relatively solid, then perhaps that gives the buck its next leg back to the upside.
Yeah, it's interesting, this chart, because it's almost a mirror image of the 10-year yield chart as well. If you take your 104 level as the 420 level in 10s, we had that little dip below last week, and I mentioned it in one of the topics last week. If we got to move below there, we'd see the dollar weaken. And as you can see, that's happened. And now we're back above it and the dollar's picked up a bit. So it's similar patterns. Yeah, we're still in the range. There's nothing for Trump to get worried about. Though he did remark that it's more directed towards the yuan and the yen that he's got the real problem with right now. So that's something that those guys will need to look out for if he takes over. Here we are again, even with the data, been talking about housing and how it's been weak. Well, last week we got the starts and permits numbers that broke the 3-monthly losing streak. So again, we can't have a straight line in weak US data. It's going to be bumpy all the way down. And that's going to happen. The same thing's going to happen in the dollar when we get these data points. And it's all just the market chasing this Fed cut.
Yes, indeed. That is all the market is doing, and that's all we're doing as well. Right. We can finally get your long-awaited chat about the dollar CAD now.
Oh, you've built me up now. So
I really have, mate. You know, the expectations are high. Can you meet them is the question.
Of course I can. I'm not going to disappoint our viewers. I'm not going to, like you, slag off various countries and,
God,
tick our viewers off from around the globe. No, I love all those lot in Canada. Anyway, I covered this pair last week, and as we're testing the bottom of the well-worn range around 136, and despite my bearish view of the dollar last week, we saw that level hold pretty solidly, and now we're potentially heading up towards the top of the range in the high 137s, maybe up into 138. As mentioned earlier, the Bank of Canada expected to cut rates this week. There's some small element of that in this move, I think, but there's also a hint of the dollar strength, as Michael's just alluded to, via this Trump trade, and a sprinkling of this oil weakness filtering through as well, coming in last week and further into this week. If the BOC remain dovish this week with a cut and with indications they're happy to keep going, we might well get a test to the top of this range, and I'll be looking to trade the other side of that, depending on the price action if we get there. Now, the range top really starts around the 137, 70, 80 level, then into 138, 138.10. Then we have the prior April highs around 138.46. Before we then get to the more longer term highs around the 138.60s. And that 2023 extension up to 139 also needs to be factored in. So there's many levels in this one to watch and to plan trades against. I'm going to be eyeing short, starting off around that 137, 70, 80 and 138 levels. But I would keep it tight with a stop, very tight stop if those levels break. I'd look again then to trade it into the 138.60, 139 area for another go. Now, often I'd look to do one trade maybe in small pieces, covering sort of the whole area from 137, 70, 80 up to 139, but I'm just not feeling it this time. So two smaller separate trades is how I'm going to look to play it. Just trade each of those two different areas. But shorts is the way I'm looking forward to if we get a move up to those range tops.
Good stuff. Very comprehensive as always, mate. I'm not sure there's really anything I can add to that. I would say you've safely lived up to those lofty expectations that we built for you, mate. Well done. Right, let's move on to our plays of the day. Okay, something a little bit different this week. I'm looking at volatility because I think the news flow that we had over the weekend and last week, of course, with the geopolitical shenanigans going on and, of course, the IT outages on Friday and then Biden ducking out of the election campaign at the weekend. I think that all serves as perhaps a useful reminder that there is plenty of uncertainty in the world, and there are actually signs that that uncertainty is starting to increase. And of course, as we move into the summer, when markets tend to become a little bit thinner, the impact of that uncertainty as those headlines do break and hit the market perhaps is going to be a little bit more outsized than we would usually expect. I think there's a couple of ways that you can play it, and actually looking at the VIX futures curve gives me a couple of ideas. If one is looking primarily at the near-term uncertainty and betting that will persist, then you simply buy the front-month contract and you go long there. But I think the other thing that's interesting is if you look further out the curve and look towards election day in November, there's naturally what you would call a kink in the curve around the October expiry, but the November expiry is back much, much lower, around 2 or 3 index points lower. And I think that's interesting because the message the market is sending there is an assumption that the election result will be, firstly, known immediately, secondly, that things won't drag on like they did in 2020 for 2 or 3 weeks after polling day, and thirdly, that there will be a smooth transition of power, which we now know must happen with Biden having ducked out the race. And I think that assumption might not be the safest one given the experience of last time around, and therefore I think the November VIX contract deserves a little bit of attention as well. So a couple of things to ponder with that one. Ryan, I see you're looking at the yellow metal.
Yeah, well, firstly, I think I'm going to have to take that saying Michael and his kinky curves over to Twitter and see what FinTwit make of that one. So, I'm just writing that one down after this.
Oh, God. This is meant to be a family-friendly show. Turned into a carry-on film.
Well, we shall see, shan't we? Anyway, I'm going to talk about gold, and this is a nice, simple, low-risk play of the day for me this week. Gold broke out of this 2,400 level again and even took out the prior high, the May highs at 24.50. It tried to hold that break on a dip back after topping out at the 24.80s last week, but it failed, and here we are testing the big figure breakout. The price should remain bullish if we continue to hold this 23.90, 2400 area of support. I wouldn't give a trade off of this much room, though. I'd have a covering stop somewhere around 23.75, 23.80. But if it breaks 23.90 and I'm not keen on the price action, for example, we see 23.90, 2400 immediately becoming resistance, I'd look to fold up the long ahead of my stop and perhaps try and save myself some pips. Now, I've already had a little nibble at this morning, and I actually got a bit panicky and stopped myself out on the first trade. So I am looking at the moment, keeping my eye on gold. As you can see, it is holding that 23.90 for now. So I'm going to be looking to dip back in.
Nice one. Thank you very much. Well, that does bring us to the end of another show. Thank you, as always, to Ryan Littlestone from Forex Flow Live and Forex Analytics for joining me. Thank you also for watching. Hopefully you've enjoyed the show and there's been some useful nuggets in there for you. If you have, please drop a like on the video. Leave a comment as well. Let us know how you're trading the markets or if there's anything you would like us to cover in the next episode of The Trade-Off. And Ryan and I will see you again this time next week. Thanks as always for watching. Bye.